So calculating news data deviation to trade the unexpected. Now, conventional news trading is not an edge. And what I mean by conventional news trading is if you're buying when there's positive news and selling when there's negative news, that is not an edge. And that's what I would call conventional news trading. In case you don't know, trading is a zero-sum game. Forex trading is definitely a zero-sum game. For someone to win, someone else has to lose. And if the news comes out positive and everybody's buying, maybe 20 years ago that may have worked, and that's how traders made their money. But in today's markets, that is just not a trading edge. And I'm going to show you how to have a trading edge by calculating news data deviation, right? And again, just a reminder not to trade every news data release or high impact news data release. What we want to do is gauge sentiment, right, and potential forecasts from big publications, and also obviously establish the theme around what the market is potentially focused on. So when you're doing a Google search, right, there is a news tab. So when you first log onto Google, you probably start off with all, do a search on Bank of England interest rate hike, right? And it normally starts off on all. What you want to do is go to the news tab, and then if you go to tools, and then you can it will basically come up with all of the news regarding obviously the search, and the tools. You can sort by all the news recent, within the past hour, 24 hours, etc., right? And sort by relevance. But the point in this exercise is to gauge a little bit of sentiment as to what is happening. Now, doing a search on whether the Bank of England are going to hike interest rates, you can see the headlines, right? So the headlines would be something like Bank of England policymakers split on rate hike. You've got Bank of England expected, and this is backed by City AM, Bank of England expected to keep path clear for May rate raise. And then you've got Bank of England holds rates, but split vote set the stage for May, and it looks like it's interest rate hike. And again, bank votes at hints at interest rate rise, right? So you're getting some headlines from big publications like The Guardian, Telegraph, City AM, CNBC, BBC News, right? That there is a potential interest rate hike on the way, right? We're in March, and they're talking about May. So with that being said, we've established that there could potentially be a interest rate hike. Now, what we want to do is really establish deviation. Now, we're not going to do deviation on an interest rate hike, but what we are going to calculate is just news deviation on a potentially any news event. And you can use this on any news event. But again, if you want to increase your chances of a really good trade, and for the news to really react when you're trading the news, you want to establish a theme. This is just as an example of why you should be, of how to really search sentiment and themes on using Google. So let's get into how to calculate deviation to trade the unexpected. So before we get into calculating deviation, first of all, we need to understand what is deviation. So deviation, as described, the definition is the amount by which a single measurement differs from a fixed value, such as the mean, right? So the mean or the average, right? Now, if you don't understand that, the best way to kind of describe it is to really just visualize it, right? So the amount by which a single measurement differs from a fixed value, such as the mean. So if we go to the Trading Economics website, we have the non-farm payrolls, and this is under forecast, right? And this average would be considered the mean, right? This line, this dotted line, right? Now the deviation would be, even though the description says a single measurement, what we're looking for is two measurements, a high and a low, right? So the deviation really is just the deviation from the mean. So how high and how low, right, away from the mean, right, is what we would describe as deviation, right? So it's kind of like Bollinger Bands, if you know what Bollinger Bands are, where you have you can calculate one standard deviation, two standard deviations, etc., right? But what we need to calculate first is we need to find an average, and then what we're going to do is define the deviation high and the deviation low, right? And this basically will allow us to really trade news events, where what we're trying to do really is we're trying to trade the news when it comes out, and the news data that has the most impact. So the closer to the deviation we are, and especially if it goes past deviation, the higher the impact, or the more the impact it should have as far as the news, right, on the market, right? Because if we're forecasting, right, and this is the average, and then prices, let's say for example non-farm payrolls comes out and it's around the average, even though it might be slightly positive or slightly negative, it's still around the average. What we're looking for is for really price to be to when it, in order to trade the news and to have a really, for the market to really kind of be maybe potentially wrong-footed, is for there to be a forecast of the news, right? And it might stay within the average, but then the actual data release comes out and it's either way above the deviation or way below our standard average, right? And that gives us a great trading opportunity. And it's not just non-farm payrolls. This method can be used for pretty much any news event. So first of all, what we need to do is just calculate the average. So the average figure we're trying to calculate is really the average difference between the forecasted data, past forecasted data, and actual data, right? And from there, once we can calculate the average difference between forecasted data and actual data, we can then calculate our deviation high and our deviation low. So let's get into calculating the average difference between the forecasted data and the actual data. So first we need to go to our forecasted number, and for this example we're still going to continue on with the example of the non-farm employment change, and our forecasted number is 190k. Now we can use a news aggregate site, any news aggregate site, is useful as long as it has accurate data. Forex Factory is the one I'm using for this example, right? So the next thing we want to do is go to detail if you're using Forex Factory, and if you click on the folder it will give you the history. I've obviously unpacked this already, I've pressed on it already, but if you do click on for example the one above, average hourly earnings, if you click on this it will give you the history, right? But I've already done it for the non-farm employment change. Now the third thing we need to do is to calculate the difference between the actual data results and the past forecasted data for each month for the past 9 to 12 months, right? And a negative or positive figure is not relevant. So what I mean by that is, and I've done this already on the left hand side, is we're trying to calculate the difference between, for each month for the past 9 months, the difference between the actual in March and the forecasted in March. And the difference between the actual and the forecasted was 108k. The difference between 200k and 181k was 19k in February, and so on and so forth, right? So just the difference between the actual and the forecasted. So I did that for 9 months. And then what we do is we're going to add together each of these obtained figures and divide the total number to get the average difference figure, right? So we're adding all of these numbers for the past 9 months, and then we're going to divide it by the number of months, and then we get our 51k. So that's the average difference figure, right, between what has been forecasted and what has actually come out. Now, by calculating that, this allows us to create our deviation high and low, right? Because what the forecasts are telling us is what the economists, how wrong or right as an average the economists are regarding, and the data crunchers are around when they actually forecast and when they're actually forecasting the news, right? So at an extreme end, right, they will be 51k wrong either to the upside or to the downside, and that's how we get our deviation. So our 51k, right, so let's go back, so go back to the current forecasted news event, which is 190k, and add the average difference figure of 51k to the current forecasted data to get the deviation high, and then subtract the average difference figure from the current forecasted news release to get the deviation low. So again, this is what we've just done. If we look at it visually, so we've got our news release of 190k. We've calculated 51k to be the average difference figure over the past 9 months, right? So this is where economists tend to be right or wrong, or the deviation between the numbers and what is forecasted and what is actually the data that's actually come out, right? So at the extreme end, if we add 51k, we get 241, and that's our deviation high. And at a low end, we've got 139k, right? And that's our deviation low. Now, this is what we're basically looking for, is for the news to come out and be somewhere around the deviation high or the deviation low. Now, the closer to the high or the low, or if it goes beyond, especially if it goes beyond the high and the low, what we're anticipating really is the market to react, right? Is really the market to have more of an impact the closer it is, and further beyond it goes the deviation high or low, because what is being factored in, if I get my tool again, right, if we get our high, our low, and this is our average, what is being factored in is the previous number. And this is if we have, let's say for example, the chart, this is supposed to be negative and prices have been trending down. This is a buy the rumor, sell the fact, potentially, or the market is factoring in and pricing in this 190k, right, or an average of thereabouts, right? They're factoring in maybe 10k, 20k, plus or minus. Now, obviously, our deviation over the past 9 to 12 months, or 9 months in this case, is 51k, right? So if the figures that are released are anywhere close to this number, or even especially beyond, this is what we really want to see, is if it's beyond that number, or if it's beyond the higher, the low deviation, that should have a much bigger increase in the movement, right? Because these economists that do the forecasts and these data crunchers that do the forecasts have been, basically wrong, not only wrong-footed, but severely wrong-footed, right, from the average. So this is what we're doing, and this is how really you should look to trade every news event. And this is one of the reasons why when a data release comes out positive, let's say for example that came out at 195, right? Yes, on Forex Factory you will see a green figure or red figure, right? And then people kind of automatically come out and say they press buy or they press sell, yeah. And what happens is the market is already factored in the fact that maybe 5k isn't outside of the normal, right? These numbers aren't perfect, but we know that if it's outside of or even close to 51k, for example, in this example, then we know that we potentially have a higher chance, or the impact of that number is more over the extreme end, right? And there should be some market movement, right? So this gets you into a trade, but it also potentially keeps you out of trades as well. If you have any questions, just email me at info@trading180.com.